Exercise 33 on page 46 asks us to prepare a balance sheet. When we prepare a balance sheet, this is the only financial statement that is going to be presented as of a specific date. For all financial statements, we have to include a heading which includes the name of the company, the name of the statement, and the time period. The balance sheet is the only financial statement that is as of a specific date. Notice it does not say for the period ended June 30th. It just says June 30th. That is because the information on the balance sheet is accurate as of June 30th. It includes all assets, liabilities, and equity up to this point. Assets, liabilities, and equity accounts are going to roll forward year after year after year. If you have cash now and you don't spend it and you don't receive more cash, next year you're going to have the same amount of cash as you do right now. So what we have to do is look at our list of accounts and determine what are our assets, liabilities, and equity accounts so that we can list them on the balance sheet. So our assets is going to be the economic resource, something the company uses in order to generate revenue. So when we're looking at something we're going to use to generate revenue is something that the company owns. Liabilities are something that the company owes. And the equity is the net worth of the company. It is made up of common stock and retained earnings. We want to make sure that if we're completing a balance sheet as of June 30th, 2014, we include our retained earnings for the equity section as of June 30th, not as of the beginning of the month. So when we look at our list of accounts, we have equipment, which is an asset. We have office supplies, which is an asset. We have notes payable, which is a liability. We have rent expense, which is an equity account that is going to affect the equity, but it's not going to be reported directly on the balance sheet. It will affect the equity through retained earnings. Cash is an asset. Dividends is an account that will affect the equity through retained earnings. It will not appear on the balance sheet. The effect of the dividends will appear on the balance sheet through retained earnings. Service revenue is a revenue account that affects the equity. The specific account that is affected on the balance sheet is going to be retained earnings. Accounts receivable is an asset. Accounts payable is a liability because we owe this amount to be paid at a later date. Retained earnings, this is our beginning retained earnings balance, June 1st, 2014. So we need June 30th, 2014, and we get that from the statement of retained earnings. We complete the income statement to get net income. Net income is carried forward to the statement of retained earnings to calculate the ending retained earnings. The ending retained earnings on the statement of retained earnings is carried forward to the balance sheet. Salaries expense is an equity account that is going to affect retained earnings. So the expense itself will not appear on the balance sheet, but the effect of the expense will appear on the balance sheet. And common stock is an equity account that will appear on the balance sheet. So out of our assets, we had cash, accounts receivable, office supplies, equipment. These are just account balances that are given to us, just listed on page 46. We're going to put them as our assets. Total our assets, cash $1,900 plus accounts receivable $6,200 plus office supplies $900 plus equipment $13,600. For our liabilities, this is the amounts that we owe. So we owe anything that is a payable. We have an obligation to pay that. We have some other liabilities, but for this particular exercise, our liabilities are going to be accounts payable and notes payable. So we're going to owe a total of $9,900 for our liabilities. The stockholders' equity is going to be made up of common stock and retained earnings. Common stock is given to us in the information on page 46. So we know that we have $4,000 of common stock. Retained earnings that we have listed on page 46 is the beginning balance. If we add $950 of retained earnings, we're not going to see our total assets equal total liabilities and equity, because the equity should be at the end of the period. In order to have the equity at the end of the period, we need the retained earnings at the end of the period. We get our retained earnings ending balance by looking to our statement of retained earnings. So on our statement of retained earnings, we calculated $8,700 to be our ending balance. That is the dollar amount of retained earnings that we need to include on our balance sheet. So we include retained earnings of ending balance $8,700. So we add our common stock $4,000 plus retained earnings $8,700, and we get to our total stockholders' equity $12,700. If we add our total liabilities of $9,900 plus our total stockholders' equity of $12,700, we get to our total liabilities and stockholders' equity of $22,600. Notice that the total assets should equal the total amount of liabilities and shareholders' equity. If these two numbers do not equal, something is wrong. The error needs to be found before moving forward. The second requirement asks us, what does the balance sheet report? The balance sheet is going to report the financial position of the company. When we report the financial position of the company, we are showing what is the company's assets, liabilities, and shareholders' equity or stockholders' equity as of a specific date. So we're not looking at things that just took place in the month of June. Some of this cash may have been in our account from January or February, and it just stays in our account as long as we don't use it. So we're not saying this just happened during the month of June. We're saying during the time of existence for this company up until June 30th, 2014, we have total assets of $22,600, total liabilities and stockholders' equity of totaling $22,600.